Well, it's 11 o'clock. We'll get going, I think, because there's a bit to get through this morning. So I'm going to be doing bits of news. Then we're obviously going to be talking to Andrew McHattie about what happened during the course of May. And then our guest this week is Olivia McDonald from McHattie Investments. It should be interesting to see what has been going on there since they took it over. So bits of news this morning. I want to mainly focus on Gresham House Energy Storage, really, and little bits on the Octopus and the Hipgnosis stories too. Gresham first then. So this was doing very well, and then the discount cracked and the NAV has slid a bit, and it's still on a discount of about 52%. And all of this was really triggered. If you remember, we talked about this on the show on the 2nd of February, but there were problems with its revenue in the UK, and that was related to the way that the National Grid was treating it and the balancing mechanism, and also to a relatively low volatility of energy prices. So when they announced a trading update at the end of April, they said basically this is the most challenging operating environment we've had since we started. And given where they were, they said we need to prioritize paying down debt, keeping cash to build what they wanted to carry on building out. And so for that reason, we're not going to pay dividends this year, and we're also not going to buy back any stock. That is one of the big triggers for the big discount. And the NAV has gone down on the back of all of this. So they wrote it down as at the end of December 23 to 129.1p. It's possible it will come down a little bit more than this, but we'll see. I'm not guaranteed on that. When they published the results on 29th of April, they said that because they're keeping this money back to build up what they've committed to building, and there's already kind of in progress, they'll end up with more than 1,000 megawatts of batteries. And because some of those are more than 1 hour duration, that's like about 1,700 megawatt hours worth of capacity. And that makes them the largest player in the GB market with about 20% market share. There are others coming along behind them that are building stuff, but at the moment they are the market leader. And obviously that is quite a special position to be in. One of the things that they decided they wanted to do was look at how the debt was financed. So most of these things were sort of set up with revolving credit facilities so that they could build stuff out and then sell it on, or commit to building things and then raise more equity. Obviously, they can't raise more equity in the current environment. So to get all this done, as I've said, they need to borrow some more money. They've reduced the size of their debt facility because that was up to well over 300 million, and so that they've cut that down now, and they think the debt will peak at about 175 million pounds, and they're trying to reduce that a bit and also prove how accurate the NAV is by selling bits of the portfolio. So they're looking at some of the smaller projects and see if they can sell those, but nothing's happened on that front yet, and we'll have to wait and see whether that does happen. They are optimistic that the revenues will sort themselves out. As we'll discuss in a second, like the more renewables there are on the grid, the more volatile prices are, and that the proportion of renewables on the grid is rising and still rising quite quickly, actually. And also the problems that they've had with the balancing mechanism are being sorted out very slowly. And there's been progress already this year, as we flagged that there would be. And things seem to be moving in the right direction. So there are reasons for optimism. So this chart here is from the government department and sponsored to charge these things, and it's just showing you the generation mix. And you can see the coal just dwindling to almost nothing. There was still some coal in the system at the end of the year. That's now all gone, and those plants have been closed, and there's no more of those. Obviously, gas has become more important in all of this, and that's why the power prices shot up and gas prices shot up on the back of Ukraine. Nuclear they keep talking about making that a much bigger slice of the pie, but there's very slow progress on that, and I'm not completely convinced it's going to happen. And obviously, wind and solar has been the thing that's taking up the slack here. So there's been more and more of that. And then you can also see that the amount of energy being generated overall has actually slid a bit. And that is a reflection of how much tighter the market's become within the UK. So you do get bigger swings. And because of the way that the whole thing's set up now with renewables, it makes prices more volatile. Now, these charts come from the balancing mechanism through National Grid ESA, which is being privatized, and so not privatized, being nationalized, and it will be so the National Grid would have been no longer involved in it directly. What these charts are showing, that the orange bits, which is this axis on this side, is the imbalance between what's being generated and what's being demanded. And so obviously the solar's not working at night. I've marked sunrise and sunset on these. And the wind is variable. Nuclear and things are kind of baseload, so they just generate all the time. And gas, they can switch on, switch off. But because you've got this imbalance here, you get big swings in the prices. So it got very windy on the 6th of June as Storm Karen was approaching. And that meant there was too much power on the grid for big chunks of the day. And that's when you get these big negative prices. And what they do then is they actually pay the wind farms not to generate, which is a huge waste of electricity. And it'd be much better if it was stored and then released by the batteries. And this is something that the battery people have been working for a long time. And then a more normal sunny day, so we've got this sort of from the 3rd of June here, you get to much lower variations in the supply and demand balance and much less chance of negative prices. And sometimes you'll just have positive prices going all the way through the day. And that's definitely true if it's not very windy and not very sunny. So because you've got these big swings on the intraday price, you can trade that if you're a battery operator. So you can try and actually buy at negative prices sometimes and actually sell at positive ones. And that is a way of making money. But it's something to bear in mind when we come and talk about what's going on now. So what they've done this week is they've entered an arrangement with Octopus Energy for, well, they say about half their capacity. It's obviously in terms of megawatt hours, it's more than that. And they're basically handing over control of those batteries to Octopus Energy in exchange for a fixed fee. So those arrangements last for 2 years. They start from 1st of July, but they're staggered starts, so not everything will be transferred over in one go. They still get revenues from the National Grid for managing the capacity market, and they are about kind of £10 million a year on these things. And they've said that combined with what they're getting from Octopus, they're getting about 43 million a year at the peak. So you can imply that it's about 33 million of money coming from Octopus. And because they know that this money's going to come in on a big chunk of the portfolio, they think that they can almost guarantee that they'll be able to restart paying dividends in 2025. Now, Octopus Energy has sort of come from nowhere to be the biggest supplier of energy in the UK. This is just showing you all of the different people, all the different market shares. So they supply energy to about 6.8 million homes now, helped by doing things like buying Shell Energy's business. So they're a quite serious player, but they've come up from nowhere. So they can use this battery capacity because they've committed to supply renewable energy to their customers. They're exposed to these big swings in prices intraday. And so they're using the battery stuff, they've got a new way to offset that. They can also just use them to make money the same way that Grid would have done. So Octopus, it's a much better, gives it much more kind of security over its input costs, more better know where these things are going to be. Grid gets a much more predictable revenue stream. Where it might miss out is that if the optimism proves true and the revenues on batteries go shooting up again, they'll obviously miss out on part of that, but only for 2 years. So with all of that, Grid is saying that he doesn't think the NAV is going to be much affected by this. So I do think, sorry, I do think that this is kind of a good deal for both parties at the moment. But it's going to be interesting to see how it plays out, because obviously Octopus is not the only player in the market, and there are others that might be interested in doing these sorts of deals, and there are other battery storage companies out there that might want to join in. We'll have to wait and see. Now, Octopus Renewables, just briefly, I mean, this is obviously Octopus is part of the same thing, but we're not talking about that was Octopus Energy, and this is a completely separate thing. It's a fund generating power from around Europe. And as with all of these things, its share price cracked. It's gone to a big discount, about 28%. And its NAV's been drifting off too. But it's still a decent size, about 400 million. So if you remember, this tried to argue that it should merge with Aquila European. And we said at the time we didn't see the point of that. But I think what might have been going on there is that they might have thought, well, this might be a way to address our balance sheet, because its gearing is way too high. So at the end of March, the loan to value ratio on it was 47%, which is equivalent to gearing. So loan to value obviously is like the gross assets. The net assets, that's 89% almost, which is the highest in the sector. And a big chunk of this is floating rate, and they're paying 2% over the base rate, SONIA. And so that's quite expensive for them. So to try and address this, they launched a capital recycling program last year. So they've been trying to sell things off, and they've had some success with that. They've sold a couple of wind farms. They've decided they're not going to build out their Spanish solar stuff. The disposals actually added to the NAV. So that's all good. But what they've said this week is that they want to do a £10 million share buyback. I just think that's slightly put the cart before the horse. I think they should have waited until they've done more disposals and the balance sheet was in better shape. Because obviously the only way they can fund those share buybacks at the moment is through taking on more debt. And that doesn't seem to be like a desperately good idea. So they are trying to renegotiate the debt facilities. They're looking at, can they put more fixed rate debt in and pay back their revolving debt facility. We'll have to wait and see. But I just do think this is a bit precarious, and I think that the buyback is a bit premature. Lastly, Hipgnosis. Because I don't recall ever seeing this ever, not just in our sector, but just generally. Blackstone have won this auction for Hipgnosis. It was a done deal, and they've put the bid price up, which I think was very generous of them. Thanks very much. But I just don't remember ever seeing it before. So I thought I'd flag it. They say it's because the expenses of doing the deal are lower than they thought they were going to be. But I don't think they have to do this, so this is all quite good news. There is no competition inquiry, so that will remove one problem for getting this thing done quickly. They are going to publish some documents very soon. They say by the end this time next week. Then we'll have a proper timetable then. They're still saying completion within this third quarter that we're it sort of starts on 30th of June. So yeah, all good news really, but it's just strange that they've done this. Right, enough from me. Let's just hand over to Andrew.
Great, thank you very much, James. That was all very interesting, and I will just switch over my screen here and then talk about the movers over the month. Just before I do, just a quick extra on Hipgnosis songs, which is to do with the exchange rate, because of course it's the dollar offer, and the sterling dollar rate's been unusually strong, so it's gone up to 128, which means that the value of the offer has come down from 105 pence to about 102.4, I think, which is just relevant if you were thinking of selling out in the market instead. So as you say, the generosity of Blackstone there is somewhat balanced. Anyway, last month was a pretty decent one for investment trusts, and the average trust went up by about 2%, really in line with global equity markets, which were having a reasonable month. And the UK market, of course, went up. We saw the FTSE 100 index breaks significantly through 8,000 and stay there. And actually, UK smaller companies also made some progress, which is a little more rare. So on the list of risers, there's plenty of double-digit gains there, including some UK smaller company trusts. So that's good to see. But I think there's a lot of special situations here as well. And obviously, there is a lot going on in the industry with all of this corporate activity. And I'll just talk about three of the risers that struck me as particularly interesting. So I'll talk about Crystal Amber, GCP, asset-backed income, and Hydrogen One capital growth. But there's some good rises there, and actually far fewer fallers of significance. Only two double-digit fallers here. Mainly the declines were quite muted. If I'm looking for a theme here, I think there's a few here which are emerging markets related. So you can see there's BlackRock, Latin American, India, Capital Growth Fund, Pacific Horizon Trust, JP Morgan, China. But I'm not sure there's really that much of a theme. So I'm just going to pick one to talk about this morning, which is RIT Capital Partners, which has a relatively high profile and might be owned by quite a lot of investors watching this. So let's move on and talk about Crystal Amber, which I have spoken about before actually on these videos, because it's a very interesting special situations trust that has really some quite peculiar factors involved with it. But it's worth following. I think it's an interesting trust. And you can see it's actually had a good month. This is a year-to-date graph, and you can see this significant rise over the last couple of weeks, not apparently related to a rise in NAV here, but you can see the discounts come right into just under 20%, having been much wider. And there are some very specific reasons for that. But I think it's worth starting with a more general point, which is that this trust has been in wind down for 2 years. And when you read about trusts entering wind down, I think it's universally regarded as a bad thing when they say, look, it's going to take some time because we want to manage the wind down to make sure we're maximizing the value of the assets. And I think that's generally regarded negatively by the market because people want certainty and they want to know when they're going to get their money back and exactly how much it's going to be. But I think Crystal Amber is quite a good illustration, actually, of how that process can work very well, and that actually much more value can be generated from assets if they're sold at the right time. Because the trust actually did have quite a big win with its sale of Hurricane Energy at the end of last year, which really was at a much better price than anticipated. And it's had further good news now about two of its other holdings. One interesting one is the banknote printer De La Rue, which is a quoted company in London. And for ages now, the trust Crystal Amber has been saying in all of its reports that the strategic value of De La Rue is greater than its operational value, and that the company makes a very attractive takeover target. And sure enough, now De La Rue has announced it's in discussions which may lead to the sale of some of its divisions, or maybe all of its divisions. We'll have to wait and see. But that's been good news for the De La Rue share price, good news for the NAV of Crystal Amber Fund. At the same time, more or less, it's had good news from its largest holding, which is an unquoted holding in a medical devices company, Morphic Medical, which is basically accelerating its route to the market in the US. And so that augurs well again for the valuation there. This is quite an opaque trust, I find. It's quite difficult to get information from it or on it. It doesn't publish a nice monthly fact sheet to tell you what's going on. And in fact, it doesn't announce its NAV either on a very regular basis. It's only once a month. So we don't yet know exactly how these gains, particularly in Morphic Medical, might translate into the monthly NAV. But the market is effectively taking into account the fact that the NAV is likely to be going up quite sharply, and that's why these have rallied. And it's hard to say whether there's good value here or not. Probably is still some decent value here. There's one extra factor that I think the market might be largely overlooking as well, which is that there's potential deferred consideration to come from the hurricane energy deal, which could be very significant. So there's quite a lot going on in the background here. I think we'll probably see Crystal Amber on the list of movers in future months to come as well. Next up, rather different, but actually similar charts, GCP asset-backed income, pretty flat for nearly all of this year, very flat actually, and then it's had this fairly sharp increase over the last couple of weeks. Again, you see this movement in the discount here coming in apparently quite sharply. Again, there's a very specific reason for this, which is that the company which has entered a managed wind down is starting to pay back capital. And the thing I found interesting about this is that this was all public information. Of course, we all know that the company is in managed wind down and more or less that it's going to have some of its assets available in the near term to give back to shareholders. But when Gabby announced that it was going to give money back, the market reacted as if it was a great surprise, actually, and marked the shares up, which I find a bit puzzling. But maybe there's a read across there, actually, that potentially if you're following other trusts that are in wind down that haven't said anything to the market in a little while, but you're anticipating a repayment of capital in the near term, that could actually harbor some additional value there. In this case, actually, there was a double dose of good news because initially Gabby said it was going to pay back £85 million. And then actually it had a further big loan repayment, which meant it could increase the repayment of capital to 143 million, which means it's going to instigate a mandatory repurchase of 37.5% of the share capital at NAV, which after the payment of the dividend is going to be 89.67 pence per share. So this was good news. There's just something I want to point out here, which is that if the market is working efficiently, and I think that maybe is an if, we should see the share price fall back again next week because the shares will go X this right, the buyback, the repurchase right. And that's really like passing an ex-dividend date because you're not going to have 37.5% of your shares bought at nearly 90 pence. So this should, in theory, mean that the share price should fall back next week after 10th of June from 78.6 to 72, I've worked out. That's just maths, so it'll be interesting to see if it does work out exactly like that. So in this case of companies returning capital, it's interesting that we see the spike up, but we should definitely see the spike down again. Let's see if that plays out that way. A different kind of rise now, Hydrogen One Capital Growth, which is a tremendously volatile stock on the whole. I'm not sure it shows up very well on this chart, actually, just because of the scale, but you can see it's effectively moved between 40 and 65 pence this year, which is actually quite a broad range. And if we were to take the chart further back, we'd see even more volatility. We've seen a rise again in the early part of May, which was due to the NAV release for the quarter. But if we, just before we move on, if we have a quick look at the chart here showing the discount, you can see these are big figures here. It's on a very big discount in common with many of its growth capital peers, because there's still not very much in the way of appetite for growth capital. There's still a lot of skepticism. And I think probably that's going to remain until we see a real shift in interest rates and people start to have a further look at more speculative growth investments. Nevertheless, the first quarter figure was good here. It was marginally up, which I think is good news in this environment. And it was good news for Hydrogen One because there was a currency headwind. But I think this trust is really approaching a very interesting point in its development now, because for a few months now, the managers have been talking about the maturity of the portfolio and how it's approaching the exit stage for some of its investments. And they say that 2 of its holdings have appointed bankers to consider exactly what they're going to do next. And I think this is the real acid test for the trust, particularly in the face of some current skepticism about the values. Because, of course, if you are achieving exits, actually real cash exits at a premium to your holding values, then that, I think, shifts how people will perceive the current NAV. So on this 50% discount, I think there's actually quite a lot of scope for positive response on any further news. Clearly, these are a bit of a high-risk proposition. They are extremely volatile, so not for everybody. But I think if you are of a speculative bent and willing to accept a lot of risk, then there's quite good scope for potential uplifts here. Changing tack now to something completely different. On the downside, RIT Capital Partners shares dropped about 10% this month. And this is such an interesting story, actually, and I think it's really a story of a fallen star. I've been looking at the market for a very long time, and RIT Capital was always, I think, held up as an exemplar of the benefits of the flexible investment sector, and the trust for many years was able to produce excellent statistics showing how it had benefited considerably on the upside during bullish market conditions, but actually protected value quite well on the downside, not participating in the downside anything near as much as the upside. And it did have a good track record for many years, but that seems to have faltered. And this chart, I'll explain exactly what I'm showing here. It's a longer term chart. It's 8 years. RIT Capital share price is the black line, and it's plotted here against the FTSE All World Index in blue, which is just a proxy. That's not really exactly what RIT is trying to track, but it's a decent comparison, I think, for anyone who's considering where they're putting their money in broad equity markets. And you can see that for many years, actually, there was a very strong correlation. And then it broke down, really, in the autumn of 2022, when we've seen actually global equities do quite well and RIT do very badly in share price terms. And a lot of that is down to this very significant derating that we've seen. And this is a year-to-date chart where you can see actually this year, the rating has generally been between 20 and 30% discount, which was unthinkable actually a few years ago with RIT Capital. And you can see this decline over the recent months, which followed actually a much better prior period. So I think what's happened here is that effectively this trust has lost its performance edge and it's lost its luster as a result. And it's been quite savagely marked down by a market which is not prepared to tolerate underperformance any longer. So, this discount, I think, is really quite remarkable because RIT did sustain a premium rating for a long time. And actually, as recently as the autumn of 2022, not really that long ago, it was still on a premium rating. So it's fallen off quite rapidly. And I think what happens many times with investment trusts is that they seem to anchor on a particular discount or premium rating. And my sense here is that RIT Capital has shifted to this new range. From what I've read and what I've observed in the market, the new range of acceptable valuations here seems to be a discount of between 20 and 30%. So of late, if you've basically bought on a 30 discount and sold when it rallies to 20 and vice versa, you've done quite well. So down to 28 now, which is at the broader end of that. We'll have to see what happens with the discount, but it may help actually if RIT is able to generate some good news from its private portfolio, which is really the source of much of the pessimism here. It's quite large at the moment, just over a third of assets, and the trust says it is going to reduce that down to something like a quarter over time, but it's going to need some exits, of course, to do that. The trust historically has had very low exposure to technology in its equity element, which is about 40% of the portfolio. And that's obviously caused it to lag quite considerably. I think it might want to address that because there's a new team in place, really. It's a self-managed trust. It has a new chief executive who joined in March. and the chief investment officer has only been in place since the end of last year. So I think investors may want to give them an opportunity to prove their worth now. But RIT has some work to do, I think. It is buying back shares to try and address that discount, but so far that doesn't seem to have been tremendously effective. I think it's going to be a really interesting trust to watch because it could go one of two ways, of course, but effectively, I think if the performance doesn't improve on a relative basis, we're probably going to see that existing discount range stick, so 20 to 30%. But I think there is a significant possibility actually that the performance will pick up, or there could be some shift in strategy here, which enables investors to look forward with more confidence. And at that point, we could see a re-rating. It's certainly one to watch, I think. On that rather non-committal note, James, I'll finish and hand back to you.
Oh, thank you, Andrew. There was a question actually in here just asking where do you think the board wants the discount to be? I think I'm pretty convinced the board wants it to be the discount to be a little lower than where it is now. Do you agree?
Well, definitely. I mean, I think it probably is a source of some embarrassment at this time because of the wonderful history of the trust, actually, which is totally at odds with where it's currently sitting. So I'm not sure they'd like to have a discount at all. I mean, I think they'd like to get it back to a premium rating, but given that might be a little too ambitious at the moment, they've really got to be aiming to get that discount, I'd say, into, well, I mean, probably more in the 10 to 20% range to begin with, but certainly I think considerably narrower than this current position.
Yeah, I think that. I mean, they're quite optimistic though. They're going to sell things, and they're going to sell things for more than the NAV, and it's all going to be wonderful. So watch this space.
Yeah.
Thank you, Andrew.